And welcome everyone to this session by Clear Tax. My name is Preeti Khurana, and today we've chosen a very interesting topic, which is about tax planning for millennials who are in their 20s and 30s. Now, I hope you'll find this session of value. Just keep asking us if you have any questions. I'll try and respond to them as we go ahead. So, this is a quick check on what we are going to be talking today. Uh, we are going to begin with, for millennials, we keep receiving these questions as to, how to make a budget, how to start saving, how to start investing, what are the key principles to follow. So we are going to focus on how to make a budget, how you can begin your investing journey, understanding all about tax saving, and of course, how to maximize Section 80C. Then you have, we are going to be talking about ELSS, why it's so important, why it is talked about. We will look at certain investments beyond Section 80C, and we are going to share some other smart hacks with you. Also, we received some questions. Some of you wrote to us asking about a few questions, so I'm going to take care of that towards the end of the presentation. So let's quickly get started. Making a budget. I think this is something that everyone has to do, everyone must do, from the finance ministers to, people who run a household, uh, companies. So making a budget is pretty much important, relevant, no matter what you do in your life. So, you have to earn money or you have to spend money, and that's where making a budget comes into the picture. So it's not only for countries, it's for not only for enterprises, companies, businesses, it is also very, very relevant to individuals. Now, how to go about doing this? Now, what happens is that, increasingly we are seeing that the world is moving towards, a situation where people prefer to spend their money rather than to save it. So they have spending goals. Usually, they have goals around, perhaps buying latest gadgets or having, popular experiences, and whether it is dining or, and really, like, don't misunderstand me. Nothing wrong with that, but essentially, if you want to build, good. Financially healthy life, then you have to focus on making a budget. Now, many a times, as a millennial, of course, life, you do want to enjoy what life is about to bring you. But once you decide to make a goal with respect to how you're going to spend your money, that can make all the difference to your financial lives. Now, an essential part of making a budget is, even governments or companies look at how much money is available to them, and from there how much money they want to spend. I think that's just a very basic premise. So I'll take a very simple example. Say if you're earning, just for the sake of example, if you're earning rupees 10,000 a month, then you need to budget. Now, spending that 10,000 rupees, do you want to spend 6,000, save 4,000? Can you go a little further? Can you save, maybe 5,000? Whatever your goals could be. Now, this could also be a function of, if you have dependents, or if you have other goals, you are, perhaps there's, it's difficult for you to save because maybe, you're running a household, and your expenses are larger. But on an average, I would say it makes a lot of sense for most individuals to make an attempt to save at least perhaps 30 to 40% of, what they are earning. So very, very important to target somewhere between the range of, say, 20 to 40%. Now, if you're a bachelor and, you don't have many commitments towards spending money, then you can go a little further. But and yet, you should try and save at least 20% or about 25% of what you earn. So that's the first goal, looking at how much you want to save. Now, there's also a very interesting concept of paying yourself first. So, a lot of taxpayers or individuals are unsure what this term means, and it's actually a very popular concept. What it says is that once you get your salary and, you go to a restaurant, so you're paying the restaurant business. If you go shopping, then you're paying whoever is manufacturing or selling those goods. If you are paying your house help, so of course they've given you some services, but they get paid first. So perhaps the only way you can pay yourself is by investing. So that's the concept of pay yourself first, take out money from whatever you have earned and invest it, save it, and essentially that is the way you can pay yourself first. I'm sorry, there's some kind of a power outage here. My apologies, there's a power cut, so I think. Okay, all right, I'll just keep going on. You can for sure hear me. The other way to succeed at budgeting is to start tracking your expenses very, very closely. Now, the way to begin this exercise is actually, looking at, say, for example, creating an Excel sheet and plotting every single expense for a continuous period of maybe 2 to 3 months. And that can give you, great amount of visibility into where your money is actually going, from buying like a 300 rupees coffee to spending 2000 rupees at a dinner. Your money could be going to various places without your knowledge, and sometimes it may so happen that we may not even realize that by the time the month ends you've actually spent close to 5 to 8,000 rupees just on buying coffee. So many a times there are youngsters who take this up very seriously, and who want to truly indulge themselves in coffee, but not by paying to another restaurant. Perhaps they can look at other considerations, buying a coffee machine and what have you. So what I'm trying to explain is that tracking your expenses is one of the key exercises when you're looking at creating a budget. So track your spending, pull up an Excel sheet, or if you're a pen and paper person, then inculcate a habit of putting together every expense. You may of course consider a threshold. You may decide not to track anything which is up till a certain amount, and beyond that amount you start tracking, or you can track it on your telephone, mobile phone, or your computer, or even a notepad. And in that sense, in about 2 to 3 months, you'll get a good sense of where your money exactly goes. And that is when the step comes of how much you can look at your saving, how you can manage your saving. You can fix a goal and then look at where the money is going and how you can cut back on unnecessary expenditure. The other concept, of course, is investing. That's one of the main considerations. When you start to save, then you don't know how to answer the question of how to invest, where to invest. So here are some quick tips on how you can begin your investing journey. Now, if you're in your 20s and this is your first job, you've just started making some money, and if you're looking at some avenues, then the first idea is to start investing early. Don't delay the decision. If you just started making money, don't put it off until you want to just blow up 1 or 2 years. You don't want to worry about saving, but beginning early can give you significant edge. I mean, those who begin their investing in early 20s, they have a long horizon before they retire. They have, like, they could be perhaps looking at close to maybe 35 odd years to continue to invest and benefit from early investing. So the effect of compounding and the effect of gains can be phenomenal when you begin very early. And it also gives you the sort of the freedom to curate your financial goals according to what kind of lifestyle you're looking at, what are your goals, in whether you want to buy a house or you're looking at buying a vehicle. So the sooner you begin your investing journey, the better the returns and the better the goal setting will take place. Also, another thing to keep in mind, which is very, very simple, is actually to invest regularly. So what happens is that many a times when we have the money or we have the funds we intend to invest, but when we run out of money, we it's investing is probably the last thing we want to do, and we don't want to park our money. We want to have access to it on a quick and early basis. So what we suggest is that you invest at a regular basis. Either you can get into SIPs, which are systematic investment plans. You can look at withdrawals, automatic withdrawals that happen through your bank account. Now, many a times, and that is at least a lot of people who begin their career, what they can effectively do is actually keep two bank accounts. So, keep one account for receiving all your salary, and whatever you want to invest, make sure on the same day you have a running instruction that X value or X percentage of your total salary goes from this primary account to another account for the purpose of spending or investing. You can choose whatever, and the other account is for the other objective. So, one account for spending and one account for investing. And whatever is there in the spend account, you can freely spend that money. You can link your credit cards to it. And the other account, which is meant for investing, again, from that account, you can set up, automatic SIPs, or you can park in recurring fixed deposits. I mean, once you figure out what are the kind of instruments you want to get into, the whole exercise will become much more appealing, and you would have literally taken the first step when you set aside corpus to invest. So automate your investing, and do that on a regular continuous basis, month on month, no matter what the economic scenario, whether there's a war happening in the world, whatever's happening to the economy. So long as you are in your 20s and 30s, you have an excellent early start to begin your investing journey. And usually all economic cycles are cyclical, so they come and go, and downturns also come and go, but on the whole, you tend to benefit from all of this in your portfolio. The other important step when you begin your investing journey is also to look at what is your risk profile. How do you view risk now? Understanding our risk profile is actually, it's very sort of closely connected to our nature. Are we risk averse? Are we willing to take certain risks? And based on that, you can identify what are the kind of instruments you want to get into. Now, some of you may be averse to equity investing because it comes with a certain degree of risk. And remember, the higher the risk, the more the reward. But it doesn't have to be cryptocurrencies, which we have seen super risky, but some of them have terribly crashed. So a certain amount of risk can bring you a slightly higher rate of return. It can open the door to receiving a slightly higher rate of return. But if you're risk averse, which means that you prefer to park your hard earned money into assets, into instruments where even though the return may be less, yet there is a surety, you have more control, or you have more guarantee that you will receive your whatever interest or whatever growth element is there, and your corpus is safe. So if that is your investing style, then you go for that. If you're okay with some risk, then go for equity. Yet your portfolio has to be a mix of both of these. So your portfolio should actually be a little bit equity and a little bit fixed instruments. Now, a lot of people ask this question, I don't know how to look at my portfolio. What is my portfolio? So I would say, use a simple Excel sheet and put together whatever assets you own. So if you have fixed deposits, plot it there. If you have PPF accounts, put it there. If you have NPS, that is equity link, put it there. If you have mutual fund investments, and put it there, and just pull out an aggregate and do a percentage. So you'll have 100% portfolio split into PPF, fixed deposits, equity, mutual funds, and so on and so forth. Now, from here, you can get visibility into how much equity you have and how much debt based you have. So normally they say that if you are 30 years old, then 100 minus 30 is 70. So around 70% of your portfolio could be equities, but that may be too high for someone, that could be too low for someone. So you have to figure out that sweet spot of where you want to be. And what we've noticed increasingly, that a lot of people actually have a huge fixed income kind of scenario in their portfolio. So they will have fixed deposits, they will have debt based instruments, they might have PPF, and they'll have other instruments where the return is guaranteed, the principal is safe, but the percentage return that you get may be fairly low as compared to equity. So if you have that kind of a scenario, then think about what kind of risk you are comfortable with, how much equity exposure you are okay with, and when the market falls, you can use various strategies to sort of ensure that you can rebalance your portfolio, and we can perhaps discuss that at another time. But essentially, your investing style should be in agreement with your risk profile. So spend some time understanding what your risk profile is, and then figure out what is the kind of investment you would like to make. Also, very important step for somebody who are in their 20s and 30s. They should essentially focus a lot on not having the temptation to exit. So many a times, what happens is, um, people exit investments because the market has crashed, or there's something which has some event which has come up. So it's very, very important to just hold on, just sail the rough waters, and then you will actually gain from these kind of downturns when you invest in them. When your SIPs are utilized, they buy funds at a lower value, then you end up benefiting from these kind of downturns. Now, coming to understanding tax saving, and I see that someone has said that we focus more on understanding tax and maximizing Section 80C. So I'm going to touch upon that next. Now, understanding tax saving, I think that's important for everyone who's making money. They must look at tax saving. So, tax saving, just from a very basic standpoint, begin with your salary slip. So, pick up your salary slip, see what are the various kinds of allowances, what are the various kind of heads which are appearing in your salary slip, what exactly it is saying. So, you will see there are amounts like basic salary, HRA, there could be allowances, there could be reimbursements, there could be deductions. So just sit down and see what your salary slip looks like. And this salary slip also has a tax calculation. So it will have tax calculation, it will have amounts which have been deposited to your EPF account, it will have tax deductions or TDS which have been deposited with the government, and it will give you a fair idea of roughly how much you are earning on a monthly basis. And usually employers also maintain they have your annual tax statement, so you will be able to see what your annual tax statement is looking like. Where are your what kind of taxes are you paying, how much tax are you saving? So a good place to begin is your salary slip. Now try to understand what are the various types of tax benefits your employer is ready to offer you. So many a times employers are ready to offer you reimbursements. So they give you a CTC number, and from that they allow you certain reimbursements. For example, you may be allowed to reimburse telephone bills, broadband bills, and if you have other gadgets that you're using, if you're using like some kind of internet connectivity. So all of those may be reimbursable to you, and reimbursing these helps you save taxes. So essentially, you are paid this money as a reimbursement, and it does not flow through, the route of salary, TDS, and all of that. So no tax is deducted on it. Uh, Again, look at what are the various types of tax deductions which are appearing in your Form 16 or your salary slip. Is your employer asking you for Section 80C? What exactly is 80C? So Section 80C, we are going to come to that in more detail, but essentially your goal is to make sure that whatever tax benefits are available through your employer, and maybe your employer has a portal where you can go and access the various tax benefits, or like I said, they may have your annual tax calculation, they will have your salary slips, and these are all great places to begin to understand what are the various allowances, payments, etc., which are available to you and you can benefit from. Now, the other place to begin also is your income tax return. So if you've never actually if you've never actually had studied your salary slips in detail, yet you have at some point filed your tax return, then that's a great place to start. So look at your income tax return. It will have various heads of income. You will see how much has been earned under salary, what has been earned under other sources, which is usually interest income, what are the tax saving deductions which were allowed to you, and then you can get a general sense of what tax saving will look like. Now, tax saving is actually an important component when you're sort of making, preparing your annual income. Tax saving essentially means that there are certain ways or means which are legitimate, which have been allowed in the Income Tax Act, so that you have to pay lesser tax. Now, these are provisions which were incorporated so that you can meet certain investing goals. For example, there is PPF. Now, what PPF is actually, it's Public Provident Fund. You are allowed to invest 1.5 lakhs per annum. Every year, you can invest 1.5 lakhs, and that's the maximum you can invest. You can invest less than 1.5 lakhs as well. Now, whatever amount you invest in PPF is eligible under ATC, and therefore when you're doing your salary calculation, tax calculation, if you have invested say 1 lakh rupees in in PPF, you can claim that under ATC. Say if your total salary was rupees 9 lakhs, then from 9 lakhs you can deduct 1 lakh, and you only have to pay tax on 8 lakhs. But the maximum you can claim under ATC is actually 1.5 lakhs, and there are several other options available under ATC. So essentially, you need to figure out what are all these options, what all is available, how you can maximize, and how you can benefit from these kind of options and tax saving benefits which are available to you. Now, just let's look at ATC. Now, here is a slide that explains how you can reduce your tax outgo by 46,800 rupees under Section ATC. Now, whatever contribution you make to Employee Provident Fund, this is your own contribution. This is 12% of your basic that is deducted from your monthly salary and deposited to your EPF account by your employer. So, like this amount that you contribute to your EPF is eligible under Section ATC. Similarly, if you're making investments in ELSS, which is equity linked saving scheme, it's actually a kind of a mutual fund which invests 65% or more of its corpus into equity shares in the equity market. So these funds, these kind of mutual funds are called ELSS. They have a lock-in of 3 years, which means you cannot exit your investment until 3 years are complete. Uh, After that, you may choose to exit, or you may continue to hold them. And whatever you invest in ELSS is also eligible under Section ATC. So, under Section ATC, you can claim the investment you have made in a particular financial year in that year's tax return. So let's say right now we have financial year 22-23 going on, and in this year, if you decide to invest rupees 50,000 in ELSS, then under Section ATC, you can claim 50,000. In this example, this person had a SIP going on for 8,000 rupees a month and ended up investing 96,000 rupees into his ELSS in that particular financial year. Now, if you're paying any premium for life insurance, that is also eligible under ATC. And here you can see that this person has actually invested 1,54,800 rupees. All of these are eligible under ATC, but however, we have to cap his total deduction at 1.5 lakhs, because that is the maximum you can claim under ATC. And therefore, effectively what this person has been able to do is that he has reduced his tax outgo by 46,800 by reducing his or her taxable income by 1.5 lakhs. So, we actually saw, and we figured out recently that people who come and file their tax returns, they don't maximize ATC, they don't exhaust Section ATC fully, the 1.5 lakhs limit, and that's leaving a lot of money on the table. So, you know, if this is something you have not yet thought about, it's a good time to begin tax planning and to begin thinking about how you can maximize ATC. Like I said, you can, although EPF is eligible, your contribution to EPF, you can look at getting into ELSS. If you are looking at a risk averse instrument, you can look at PPF. Life insurance premiums are eligible. If you have done repayment of principal of a housing loan, then even that amount is eligible under Section ATC. Now, coming to ELSS, I think we also had a question somewhere. You must also, yeah. So, for long-term investment, why should we choose ELSS instead of NPS? NPS is EEE. Unfortunately, NPS is not exempt. Um, Under NPS, you can withdraw 40% of the corpus tax-free, and the remaining 60% must be parked into annuities. So, you need to park that money, and annuity income is fully taxable. So, if you're earning any money via annuities, that becomes fully taxable. So, I don't know who it was who said that NPS is triple E. It is not. PPF is triple E, where there is exemption at investment, there is exemption at increments, which means interest is exempt, and there's exemption at withdrawal. So in all of those scenarios, you have an exemption. But in case of NPS, at the time of investment, you have an exemption, but that's limited. You don't have, it's not like you can invest as much as you want in NPS, but your deduction is limited to a certain amount. Similarly, when interest accrues under NPS, there is no tax, but at the time of withdrawal, only a certain percentage, 40% of the corpus can be withdrawn in a tax-free manner. Remaining has to be compulsorily annuitized. Now, coming to ELSS, ELSS is again great way to save taxes. Um, and as you know, equity investments are exempt up to when you have capital gains from sale of equity or equity linked mutual funds, then up to 1 lakh, there is no capital gains. There's no tax on capital gains of up to rupees 1 lakh. So this has one of the shortest lock-in periods. If you look at PPF, you must be committed for 15 years. They also have a shorter horizon of, I think 5 to 10 years, where you can withdraw in case of some emergency, medical or some other emergencies. Money can be withdrawn from PPF. But ELSS effectively has a very short lock-in period of 3 years. Although we recommend that you continue to hold this for 5 to 7 years, when the real value you will be able to generate from your investments. Also, ELSS offers a far better return since these are equity based. 65% of funds are of an ELSS fund are invested into equity markets, and if you stay for a longer period of time, maybe 5 years, 7 years, you benefit from the longer duration. So whereas PPF, the government announces the returns, the rate of returns on an annual basis, and these have been consistently by a few basis points, these have been coming down. Whatever our government schemes, small saving schemes, in all of those, the rate of return has been falling. So even though it is assured that in case the markets grow too well, then you miss out on that bus. So I think there is some kind of a balance that you may have to figure out for investing between equity and debt based. Also in ELSS, you can choose to do a lump sum, or you can invest via SIPs. For example, we are sitting in the month of November, and if you choose to do ELSS for your tax saving for 22-23, then you can, and you want to save, say, rupees 80,000, then you still have about 3-4 months, and you may not invest 80,000 immediately. You may commit to investing a certain amount on a monthly basis. You can get into SIPs, and you'll still meet your tax saving goals. So that's a great way, to do tax saving, to do investing, and also to be able to look at your investments from an angle of when you exit them, what will be the tax implications like. So in case of ELSS, taxes may not arise if your total capital gains are limited to rupees 1 lakh. For ELSS also, another beauty is that you can, all you need to do is online, use our app Black, and you can just begin your SIPs. You can just electronically, no paperwork required, and you'll be able to invest in a fully online paperless fashion. Coming to some deductions beyond Section 80C. Now, if you look at other deductions which are available to you, one of them is health insurance premium. This is becoming very popular. It was popular after COVID. This has picked up quite a bit. People are very interested to explore if they can save taxes by paying for a health insurance premium. So deduction for health insurance premium paid is eligible under Section 80D. It is 25,000 for yourself, your spouse, and children who are dependent on you. And you can also claim an additional deduction for insuring your parents, which is rupees 25,000 if they are less than 60 years of age. But if they are more than 60 years of age, then you can claim a deduction of rupees up to rupees 50,000. So on the whole, you can say that you can almost claim 75,000 worth of deduction when you are making premium payments towards health insurance, and this is allowed to you under Section 80D. What we have observed, over the years is that the number of people who are claiming Section 80D has been going up. This is something that people have warmed up to, and actually, it's a great idea to, not only save taxes, but a visit to the hospital can set you off by a few lakhs. So it makes a lot of sense to explore what are the various health insurance plans which are available, what all you can invest in, and how you can benefit from them. Now, coming to NPS, NPS is also a great way to save for your futures, to save towards your retirement. Now, most of us who have private jobs, we will not be getting any pensions. So this is the national pension system, and contributions made to your NPS account are eligible under ATC, where the limit is 1.5 lakhs, and any self contributions are also eligible under ATCCD 1B. So even in one ATCCD, you can claim your own contribution. The limit is 50,000. So you can exhaust ATC up to 1.5 lakhs. You can exhaust another 50,000 via ATCCD1B, and you would have reduced your total taxable income by rupees 2 lakhs. Say if your annual income is rupees 20 lakhs, then 2 lakhs out of that straight away gets knocked off thanks to ATC and ATCCD1B, and you end up saving significant amount of tax. Now, there are various other deductions available under the Income Tax Act, such as ATG. There is ATE for, when you are have made payments towards an educational loan, or if you're supporting a differently abled family member. Now, depending upon your case-to-case scenario, just explore what are these various deductions which you can claim, what are the various choices which are available to you, and in this fashion, you may be able to take your total deduction even higher. Remember, all these Section 80 deductions are applied before your total tax is calculated. So your total income less all of these deductions, and on the remaining amount, tax calculations are made. So whatever you can maximize through Section 80C, 80D, and on the remaining 80 sections will actually be of great use to you in reducing your total taxable income and your total tax outgo. Now, coming to some smart hacks that you can use to increase your take home salary. Of course, a common suggestion is to claim as many deductions as possible. Claim your HRA, claim LTA. HRA, of course, all claims should be legitimate, should be capable of being proven, and should have actually taken place. So, if you live on rent, if you're paying rent, then that's only when you can claim your HRA. If your employer is offering you any reimbursements, then go for those. Make sure you submit your bills on time. Uh, just ensure that you're claiming these deductions accurately and you're not missing out on them, because whatever reimbursements you get, you save tax on them. And if you fail to submit the bills to your employer, then there's no way to claim them while filing your tax return. So in case you miss out on claiming reimbursements, and the employers usually provide a certain date by which you need to submit your bills. In case you miss out on that, then essentially you miss the tax benefit on it. So make sure you are in compliance. Also, you can, have a chat with your employer, look at NPS. If your employer also begins to contribute, then not only your total NPS corpus will rise, you can also claim some tax benefits from it. Now, many a times we have seen that in many organizations, EPF contributions are limited, right? So, they are limited to say 1,800 rupees per month. That's the bare minimum the employer needs to contribute. Now, when you are making a matching contribution, you're also depositing 1,800 rupees, you're actually parking less and less in your EPF. And as you know, our elders will tell us that EPF is something that they really banked upon during their retirement. So go have a chat with your employer, make voluntary contributions, reach that maximum level that you can afford to make. Remember, there's no limit on how much you as an employee can contribute to your employee provident fund. So make an extra effort. The only benefit of making extra deposits to your EPF is a, the rate of return is fixed. B, you don't have a tendency to withdraw it. That's probably the last resort for many of us. C, you get this amount, these amounts become eligible under ATC. And then finally, of course, the money is deducted at source. So it doesn't even hit your bank account straight away. Your employer will deduct and deposit to your EPF account. And therefore, you will just not have access to that money, and you'll have no intention of stopping these payments. So it's a great idea to start to ensure building a great EPF corpus. Also, just a last word of caution on this slide: ensure that you're declaring your tax saving investment proofs to your employer on a timely basis. Don't miss out on the due dates. Don't miss out on whenever your proofs are due, and ensure you are in compliance in every way. And if you're not, then maybe some deductions you can claim at the time of filing your tax return, but any reimbursements, any bills, etc., those you cannot take care of while filing your tax return. And now, these are some of the questions we received, and we decided to address them through this conversation. If you look at now the first question, Weber has asked us: I have founded my own startup while doing a job. Can I avail any tax benefit by investing my money? Unfortunately, Vaibhav, there's nothing in the Income Tax Act which directly takes care of this. However, we can discuss Section 54GB. This is under capital gains. Now, what this section says is that if you have sold a capital asset, and whatever capital gains you have utilized them to purchase shares of a new company, and it has to be an eligible startup, it has to meet certain criteria. If you have invested in 50% or more shares of that company and you don't sell those shares within a time period of 5 years, then the capital gains from selling off that house property could be exempt. So I'll go over that again. If you've sold a house property and the capital gains, whatever you have gained from selling that house property, you invest in an eligible company, in an eligible startup based on the conditions specified in the Income Tax Act, then you may be able to, avoid paying capital gains tax on the assets sold. So, but there are some conditions to be met. You should own 50% or more of the shares of that specified company, and you should hold the shares for a minimum period of 5 years. But as such, unfortunately, as of now, the Income Tax Act does not take care of any of this. There are no direct benefits if you're investing your money, your savings into startups, and there are unfortunately no direct tax benefits available. Now, Kushwant is asking, can we claim 44AD, which is presumptive income, for profits from options trading? The total turnover is less than prescribed. Yes, Kushwant, you can definitely do that. Now, if you want to claim 44AD, which is presumptive income tax, here, there are limits as to turnover. If this would be considered a business, so the threshold would be rupees 2 crores for you. And it also depends, probably all your dealings are nothing is in cash, so you may even have a higher threshold. So if your total turnover is within the prescribed limit and you are doing futures and options trading, you are eligible to take benefit of Section 44AD. What that means is that you will have access to a very simple form of return. You may not have to prepare your profit and loss account, balance sheet, etc. None of this will be required to be reported. On top of it, only 8% or 6% in case your receipts are digital. Uh, Only that much will be considered as your income, from this business. So if your total, say, receipts are X amount, then 8% of X, but if they are all digital, then 6% of X will be your total income. And further from this total income, you can claim deductions and all of that and pay tax on it. So huge relief for businesses, small taxpayers who run a business, or Specified professions are also eligible. They are another section. But yes, for futures and options trading, you can opt for Section 44AD, provided you meet the requisite criteria, which is you are within the turnover limit, and there is a unique way of estimating the turnover. So you have to be very careful while calculating what your turnover is. And yeah, those are the conditions. I'm living in a non-metro city. I get HRA of 3 lakhs. I want to pay this amount as rent to my mom, but the property we own is not worth of paying 25,000 rupees. Is it still possible to pay such an amount and show her ITR as rental income? Raviraj, what you want to do is you want to save tax on HRA. You want to pay 25,000 rupees to your mother, and your mother will report that in her tax return. Now, what I'm saying is this is essentially an arrangement between you two. So long as you are making a payment, the money is actually flowing out from your side, and the landlord, whoever that person is, your mother or anybody else, they are including the rental income in their income tax return, should not be a problem. But you have to essentially see, you should, this should be well supported. You should be able to satisfy, should you receive a query, you should have the entire trail of the transaction, how this has happened, how the money has been transferred, what is the rent agreement, what all is covered under that rental agreement. Is it only the premises, or you're also paying for certain facilities? So perhaps, I hope you're able to find a workaround. But essentially the key to note is that if you're claiming a tax deduction for rental payment via HRA, then whoever is receiving the rent, especially if this is a family member, you must make sure it is reported in their tax return also as rental income. All right. The next one is from Mr. Menon, who's asking, is tax harvesting useful to cut taxes from stock trading? Absolutely. So, tax harvesting is a unique way to reduce your total tax outgo. So, what you can do in such a scenario is, many a times when you are sitting at 31st March and 1st April is just about to come, and you've had gains during the year. You've had significant gains during the year. Remember, 1 lakh rupees, capital gains up to 1 lakh rupees are exempt, and any returns beyond that are taxable at 10%. So calculate what your total outgo in the sense of your capital gains is looking like, how much tax outgo you're looking at. Now, make an attempt to reduce your capital gains. One way is to set off any kind of losses that you have carried forward from previous years. The other is to exit stocks where you may have a loss on the 31st, or in the current financial year, and make a purchase again in the next year. So maybe on 1st April or whenever, when the price differential will not be super high, you can re-enter those stocks immediately on the next day, which could fall in the next financial year. So these are some strategies to actually ensure that your total tax outgo with respect to capital gains is reduced on an annual basis, and yet you are able to benefit from it. So you may not end up, paying a larger amount of money as tax towards capital gains. Okay, Shiba is asking, as students studying abroad, what can we invest in? Shiba, if you are studying abroad, I'm assuming your status is that of a non-resident Indian, and a non-resident Indian is allowed to invest in equity shares, in mutual funds. Uh, if they already have an ongoing PPF account, they can make further contributions, but they cannot open a new PPF account. But other than that, most debt-based mutual funds, equity shares, equity mutual funds, all of these instruments are available for you to invest. Just make sure whichever bank you are investing through, whatever mechanism you are using to invest, you have made full and complete declaration that you are a non-resident, because there are certain compliances required for you to be done if you want to invest as a non-resident. At the same time, whatever capital gains you are earning, they may be subject to TDS. So that also, one has to make sure. So it's important that, while you have the freedom to invest, you are fully in compliance. So, ensure you are, whatever documentation you are submitting, whatever undertakings you're doing them diligently, and your bank knows that you're a non-resident, and then you're allowed to invest in the stock market, in mutual funds. You can do all of that. Okay, someone is asking, I have US stocks and dividend. Where and how do I declare it? Can you give an example? Yes. So if you are, I'm assuming you are resident in India for tax purposes, and that's why this question has come up. Now, if you are a tax resident of India, our Income Tax Act, our tax return forms require that whatever foreign income or assets you have, those are mandatorily required to be reported in your tax return. So if you have any foreign income, which could be in the form of dividend income, interest income, capital gains, any kind of foreign income that you have, it is mandatory for you to report it in your income tax return. There's a special schedule for it, schedule of foreign assets, where you have to report their values. You have to report, what was the value at the beginning, what is the value now. If you have had any income, that has to be reported. It is included in your total taxable income, and you have to pay taxes on it. So say for example, you have you have invested in on the Nasdaq, or you have certain investments, you have a bank account in the US which is earning interest income, then whatever these assets are, they have to be reported. You have to report how much, you had a bank account, what are the bank account details, what is the balance in the account, what is the opening balance, what's the closing balance. If you've had any interest income, you must include it in your tax return, and thereafter you must pay tax on it. So all of this compliance is mandatory. Also remember that when in such a scenario where you have income from foreign assets, or you have foreign assets, it is mandatory for you to file a tax return. Then there is no exemption available. Let's say uh, you have certain US stocks, you have US bank accounts, but you did not have any income in that financial year, and you don't have an income in India, but you're a tax resident of India. In such a case, you must file an income tax return in India, where you must declare these foreign assets that you're holding them, provide all the disclosures, and that's the way to be on the right side of the law. All right, I'm just going to take a look if we have any other questions coming in. Right. Yeah, all right. That's it. So, I would highly recommend you to download our app, which is called Black, and you can use it to begin your tax saving journey. You can use it to make investments, and do write to us. Do let us know if you have any questions. We'll definitely come back to you. We have another session coming up in a few days around investing, tax saving. So I highly recommend you to make use of these sessions, to interact with us, to ask us questions, and to learn from us. Hope this session was useful to you. I look forward to connecting with you in some time in the future. Thank you so much. Goodbye.